foremost for not only having this important conversation today, but also, for your service on this body, which I believe serves an important function not only to the agency but to the general public as well. The SEC finalized Rule 6C11 in 2019 to, quote, modernize the regulatory framework for ETFs to reflect our more than 2 decades of experience with these investment products, end quote. The rule helped to usher in a process where ETF sponsors can list ETFs on exchanges and make them available to investors on an expedited basis without the burdens of first seeking SEC approval. But in combination with the ill-advised 2020 rule on use of derivatives by registered investment companies and business development companies, Rule 6C11 was expanded, and it opened the door to more complex leveraged and inverse ETFs in name only financial products to evade SEC scrutiny, along with their traditional ETF counterparts. This included leveraged and inverse single stock ETFs, which the SEC had little to no experience with compared to the 2 decades experience it had with the traditional ETFs. In fact, in the 2019 Rule 6C11 final rule, the SEC states, quote, leveraged and inverse ETFs are complex products that serve a markedly different investment purpose than most other ETFs, end quote. I would take that a step further and say that allowing complex leveraged and inverse ETFs that hold swaps and future contracts and other derivative instruments to utilize the same listing process as the same traditional, well-diversified ETFs is a policy mistake that ultimately harms investors. In my opinion, single stock ETFs and other complex leveraged and inverse ETFs represent the unnecessary introduction of leverage into our capital markets that do not facilitate one of the SEC's core missions, which is to facilitate capital formation. And due to these unique risks, that these levered and inverse products pose to investors, which have been well documented over the years by various representatives of the SEC. There's SEC and FINRA Investor Alert in 2009, a joint statement by former Chair Clayton, and the heads of the various divisions of the agency in 2020, statements by the Investor Advocate, current and former commissioners, Chair Gensler, and as well as stated in various rulemakings. I would argue that making the Rule 6C11 process available to these complex products, including the single stock ETFs, is not in the public interest and does not contribute to the protection of investors as our securities laws mandate. These risks include the fact that these products have a daily reset, which can significantly affect the returns an investor may expect to receive from these products if held for longer than a couple of days. If you consider, the real world example that was noted in the 2009 SEC Investor Alert, it quote, between December 1st, 2008 and April 30th, 2009, an ETF seeking to deliver 3 times the daily return of a certain index fell 53%, while the underlying index actually gained around 8%. And an ETF seeking to deliver 3 times the inverse of that index, daily return declined by 90% over that same time period. So if you think about it, you have an index that gains 8% over this time period. And at first glance, you might think, okay, well, the 3 times levered index should get close to at least 24%. Should return around 24% over this time, but not only does it not gain, by 3 times, it actually declines by 53%. And the 3 times inverse ETF product declined by 90%. There's also, counterparty risk, which was mentioned by Patrick, due to financially engineered derivative products that these ETFs have to hold to get these returns. We've already seen how this has played out in the past in 2008 with, exchange traded notes that had counterparty risk to Lehman Brothers. Those customers, those persons that were holding those notes had real problems after Lehman bankruptcy. And then there's the fact that these products are some of the most volatile products in the global markets. If you see, there's a July tweet from Eric Balchunas, who's an ETF analyst for Bloomberg, and he said, quote, the most volatile exchange traded product in the world is the leveraged shares negative 3 times Coinbase, which has 6 million daily standard deviation of 338%. And that's about 13 times that of the S&P 500. And if you here's a look at the top 20, most are single stock exchange traded products. These things should come with a Xanax, end quote. And finally, they have, as was mentioned earlier, they have much higher fees. I've seen as high as 1.15% for these products, which we know one of the benefits of the standard traditional ETF is a low cost mechanism for investors. This is why, at a minimum, I believe all leverage and inverse products, including single stock ETFs, should be excluded from using Rule 6011, as the original 2019 final rule had done before being subsequently amended. Alternatively, the SEC may be able to use its authority under the Exchange Act to impose certain requirements on the exchanges themselves prior to listing these complex products on their exchanges. But either way, I think it would be a mistake to continue to allow these products to take advantage of Rule 6011 and have a fast track to listing without additional regulatory scrutiny. Believe the SEC when they say these products serve markedly different purposes than traditional ETFs. Once these products are listed on an exchange, however, retail investors have varying degrees of access to them. So earlier in the week, I put money into 2 different brokerage accounts to try to purchase a single stock ETF to see what would happen. One brokerage account, long history on the street, employs probably thousands of investment advisors, would show me the quote for the single stock ETF, but would not let me purchase it. And at the bottom, it would say, we do not make this available to our customers. The second brokerage, a fintech company, I'm not aware of any registered investment advisors that they have on their platform. I was able to buy the single stock ETF, no questions asked, signing up with an account and purchasing the stock within 5 minutes. The reason I bring this up is because I think it highlights the various degrees of treatment for these products by broker dealers in the absence of SEC regulation on sales practices. On the one hand, one broker dealer restricts any and all access, and the other, offers it with no due diligence, no questions asked. And the discrepancy can occur in the market because the 2020 derivative rules failed to adopt proposed sales practices rules on leverage and inverse funds that are akin to other complex products due to pushback by industry. And I think this was a missed opportunity. At a minimum, there should be sales practice rules and customer due diligence requirements in place to govern the sale of these complex products to retail investors, especially. I mean, this would require broker dealers and investment advisors to exercise due diligence on retail investors before approving their accounts to invest in leverage and inverse investment vehicles. While we could certainly have a debate about the level of due diligence that many of these broker dealers currently have in place, say as they do for options trading, it's at least another affirmative step that both the broker dealer and the retail investor would have to take before buying and selling these often misunderstood products. And I think only after eliminating the fast track process for leverage and inverse ETFs and establishing a sales practice and due diligence framework should things like additional disclosures and education be contemplated, changes to that. For starters, including requiring the use of the term daily in the ETF name. Most single stock ETFs do have the term daily in their name. Not all leverage and inverse products with daily resets, though, include that term. And I think that's a helpful signal to retail investors that this product is different than traditional ETFs. And while I think it's a less significant action, I also think that it's worth exploring whether or not the term ETF should even be allowed to be used in the name of some of these products because of how markedly different they are. And then finally, I think it would be beneficial for these products to include in their prospectus not only the historical returns of the fund as they currently do, but also a comparison of the historical returns of the benchmark index or stock. So, for example, a 1.5 times single stock ETF for company ABC would include a table with the historic return of the fund and also a table with the historical return of the company that fund is based off of. I think that'll provide a further signal to investor to expect a divergence between the returns of the fund with the returns of the underlying index or stock. And I'll stop there and open it up.
Thank you so much for that, Scott, and everyone else. I think